Vineet Samre is our market master today. He's head of equities at DSP Mutual Fund. Vineet, good to have you with us here on the program. Thanks for your time. Appreciate it. You just heard some of these anecdotes and trivia, right? 8-bagger, 10 months and whatnot. I mean, it's just amazing. Once in a lifetime kind of market, right? And you don't get many of these. The question is, I think most people have made money to varying degrees in terms of what everyone's situation is different, what the starting capital is, risk appetite, and how they went about it. But broadly, I think one can say very few people would have been left behind. Are we at that point, Vineet, where you start to look at, protecting what you've made, and thinking on slightly more defensive lines rather than sort of, looking at doubling and trebling your money from here? What's your sense?
So Prashant, good morning and thank you for having me on the show. I think you have very rightly mentioned that at every interval one should always be thinking about one is growth, and then after a strong growth one should be thinking of how to protect capital. And clearly, if you look at the markets last 3 months, the quality factor has done well, and this is what actually we have generally followed over long term. At some points, it has hurt as well in terms of the overall performance. But I believe that the next maybe 1 year or so, we could see focus back coming back on the quality factor, because last 2-3 years, because of growth and followed by a lot of liquidity, we saw these up moves taking place across the segment. Now, most of the market is either expensive or very expensive. You don't have stocks which are really cheap in that case. So I would say that at least be focused on quality. I mean, till the time the liquidity is driving the returns, it's good. But in any case, there are some issues which leads to market consolidation. Then also, I think we should be in good hands is what I believe.
Okay. But this has been such a phenomenal market, right, Vineet? If you map the last 1 year, so in the last 12 months, the returns that this market has given you, the Nifty itself is up over 20%. And I don't think any other asset class, maybe 25%, any other asset class has not given you this kind of returns. Do you think it's easy to replicate this kind of move? Or do you think that now the market could head into a period of time-wise correction, consolidation, until we get the next big trigger?
So Sonia, let's look at the data. So one is, let's go by the fundamentals first. The last 3 years, the Nifty earnings actually grew by over 25%. And now we are actually looking at growth, which is, let's say, close to 14-15%, which also I think is getting downgraded gradually. I mean, people are coming down to 12-13%. So I think fundamentally, what drove decent outperformance in the market was also, on the back of a strong earnings growth, which it itself is likely to see some bit of consolidation going forward on a high base. And anyways, some parts of the economy is still not, in the best form today. So I think considering all of that, we'll have some slowdown in the growth. And from that perspective, ideally, what you mentioned, market should see some consolidation, or at least investors should moderate their growth or the returns expectations from the market. Secondly, I mean, a large part of the market move has also been a factor driven by liquidity, which is also witnessed in terms of the P re-rating versus the earnings growth. If you make a comparison of the returns, if you break them down into how much of earnings growth has led and how much P has led to the overall return, the P re-rating has played a very important factor. And hence, I believe that, going forward, P re-rating may not remain as an attractive a factor for adding to growth. Earnings should drive the incremental growth, and earnings themselves are in a sort of slow lane. So I would say that one should expect moderation, while flows continuing can do any kind of things. I mean, as what we've seen in the past few years. But I think as far as the expectations are concerned, we should have some moderation in the thought process.
All right. Hi, Vineet. Good morning and good to see you. And, just looking at the data that we get from the mutual fund industry on a month-to-month basis, and we were thumping the table with regard to the SIP flows. But if you look at cash levels, I'd say the top 20 mutual funds, well, that's gone up dramatically. We had the PPFA, mutual fund manager who joined us on the show, and they are at around 15-16%. Even Quant Mutual Fund, well, their cash levels are up nearly around 2 times in the last 6 months in comparison to what it was. Given this sort of liquidity that's coming in and the cash at various mutual funds, we're unlikely to see a big price correction or time correction is more like it?
So, Nigel, I think the cash is just not lying in the domestic mutual funds, but also if we consider some of the international investors, they are also maybe waiting at the sidelines because they also want to participate in the India growth story and maybe are not as comfortable in terms of the valuation. So maybe at certain price points, they would also want to look at India more holistically. So you're right. I think which is where you don't see deep cuts. Small cuts leads to good amount of lows. I think 4th June was a big experience of that where after the results came out, markets ideally should have seen even sharper cuts, but it actually restricted itself at a narrow cut. So I would say that a lot of flows which are wanting to be part of this growth story will mean that the markets will not maybe see deep cuts unless we have some very bad incident taking place. But otherwise, I think we should be overall doing well. And like you said, some time consolidation, some market consolidation should be there. But I mean, who can fight against the flows is what I can say.
Vineet, the budget is around the corner. Tell us what is your expectation. Actually, I want to know your wish list. What would you like to see happen?
No, so
And
see,
I'm
I
sure
think,
you have those conversations with your team as well.
Yeah.
So give us a flavor.
So I think in terms of my expectation, I would say that I'm looking at this budget from a very balanced perspective because I believe, first of all, government does have good financial wherewithal to maybe do justice to their capex, what they were doing. Also, there is a room for some amount of welfare spends, which has been one of the important reasons where we have not seen the low income level or the mid income level actually come in the overall consumption as a basket. So I would say that beyond capex, which needs sustenance, which is very important for the overall markets and the industry growth. But I think that to create a balance, we need more broad basing of consumption taking place. The low income, the mid income should also maybe come back in terms of driving the consumption, and any particular policy which actually drives this part of the consumption should be a welcome step is what I would imagine. On the taxation, I think there are various talks around the restructuring of the capital gains tax, rationalization of the various asset classes, bringing them all into similar periods. So I mean, all those things we'll have to see as it comes, what gets announced. But I think the capital gains tax or anything to do with the taxation on the equity is something which is going to create more sentimental volatility. But otherwise, I think in terms of the broad policies, I would want to see more broad basing of the growth matrix.
Okay, Vineet, we'll leave it at that. Thanks a lot for joining in. Appreciate your time here. That's the word coming in on the market overall, which